Yo, 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 yo. What's up? Welcome back to another CMT Lunch Hour. I will be your host today, Larry Thompson, the resident CMT on the Friday show. Boy, oh boy, is this market crazy right now, right? We've had some of the best and worst days this past week, which we'll get to, right? Kind of a feature of the environment. And it's not a healthy feature, right? It's not a healthy feature to be moving the way we're moving. And the technicals, of course, gave us some heads up, gave us some warnings kind of into that. So let's kind of dive in and figure out what we're going to be looking at today. We'll kind of take a look at the S&P 500, right? That's kind of where we'll start, right? We'll always start with the S&P, giving people an overview of this market, right? So we'll do multi-time frame analysis. I think I've been on a lot of spaces, a lot of shows recently, and there's been this topic of a trader versus an investor and what that kind of looks like and what technicals allow us to do. Shout out to Brian Shannon, right? Guy who wrote a book on multi-time frame analysis. But what technicals allows us to do is it allows us to be both, right? It sounds too good to be true, but it's not. You can take technical analysis and apply it to the monthly time frame, the weekly time frame, the daily time frame. And you can understand there's times when those time frames align and there's times when they differ. And when they differ, that gives you diversification and lack of correlation in your portfolio. And it also allows you to be a trader while also being a long-term investor, right? You make short-term decisions in your short-term account, long-term decisions in your long-term account. So what we'll do is we'll break that down, how you can kind of do that. Next thing we'll talk about is our secret superpower, right? I'm not Warren Buffett, right? I'm not this guy managing billions of dollars, right? I'm managing my own money, fortunately. It's how I want it to be for now. And there's skills and secrets within that process that allow us to benefit from things that bigger people can't. So let's not sleep on that secret superpower. Also talk a little bit about capitulation data and bottom criteria. Like what can we use to kind of see if there's a bottom coming, and what can we use to see there's capitulation data, which we highlighted, right, a couple weeks ago. And we saw a lot of it this past week, right? It wasn't the time to be pressing shorts. And what do you know? The market rocketed, and now we've been kind of trading in this inside range, believe it or not, since that 10% day the other day. Next thing I'll talk about a little bit is the CMT lesson of the day is the best day BS, right? You hear a lot of things about you can't miss the best days in the market. Well, I think one of the tricks and one of the things that I know a lot of people on here understand is that we're doing this because we want to take ownership of our financial stability and our future, right? And so if we actually dig through, we can learn that the best days tend to occur in downtrends, right? They occur near the worst days. So if we can understand that there's a cluster effect of volatility and that volatility can be dangerous, we can maybe avoid it altogether and actually be better off long-term, right? And that's where, okay, maybe in your short-term trading account, you're taking trades, but that long-term model says no, right? So that's how you can use that multi-frame analysis, which we'll get to. And then of course, chat, I'll be sharing any ticker requests. So chat, blast ticker requests my way. I'll be taking all the requests. I already see some people bully buys in there. I see everyone's kind of bearish in the chat right now. So we'll kind of see how this develops throughout the show, see if people continue to stay bearish, and yeah, we'll kind of be going from there. So let's go ahead and get started, guys. I will kind of rip here through some charts and get the conversation started. So talking about multi-time frame analysis, let's start with the S&P 500, right? You can see here, this is a weekly chart, a 5-year weekly chart. You can see we're at these prior cycle highs here, right? We're back at these prior cycle highs in 2021. Right, we had this 2022 bear market, 2023 we kind of bottomed and started this bull market, right? October 2023, right? Or 2022, right? So October 2022, this bull market leg we had, and then now we're kind of having this, right? This tariff tantrum. But the reality is we were building this distribution pattern for weeks and months before we kind of had that tariff tantrum. And we'll look at that on the shorter time frame. But the reason I bring this up is if you saw this sideways action in your longer term models, right? If you're zooming out, right, you would have gotten in, right? Maybe this base breakout, you would have seen this long-term uptrend, and maybe you started to take off some risk, but you saw this week, the environment is choppy. It's ugly out there, right? We're aware of that. But against these prior cycle highs of 480, you had really clean risk reward to potentially swing the bat, potentially add some long-term exposure. You're not trying to get in and out today, tomorrow, the next week, but add some long-term exposure, knowing that the long-term trend of the market is up, right? And that buying at levels where you have clean risk reward in that longer term account can pay off over time, right? The other piece I want to highlight here is you'll hear people like Warren Buffett talk about buy when everyone's fearful and sell when everyone's greedy, right? If we look at the VIX here, the VIX is above 40. Those are levels you see in bear markets panic, right? Above 40 is extreme panic in the market. And so you had extreme panic here, right? A capitulation indicator, a fear indicator, coupled with really clean risk reward on the longer term time frame. This 480 level is super big from a technical perspective. And so that's where the longer term time frame, you might have been adding a little bit of exposure if you kind of got out earlier at that 580 level, which we've highlighted a lot, right? That 580 level was this distribution pattern paying out. You also had oversold on the RSI here for the first time, right? You can see in a very long time. And so this might have been some time to just nibble and to add some exposure, right? We break that, that's your line in the sand, right? But you had really clean risk reward there from that longer time frame. Okay, so the next thing I kind of want to do is, you see this longer term time frame, right? We had this clean risk reward here, but when we kind of zoom in and we look at these shorter time frames, right, which we'll do here now, right? When we zoom in and we look at these shorter time frames, you can see that the price action in the market, right, is in this severe downtrend from a shorter term trade perspective, right? So you might have been selling rips here, right, which doesn't necessarily align with your longer term plan, but you can have those plans simultaneously in the market. So there's a trader and then there's the investor, and technicals allows you to do both of those things very well. So we could see here, right, we kept getting punched, and then that tariff news came out, and that's when we got kind of knocked out, right? The market was didn't have its hands up, right? It was Glass Joe, right? Mike Tyson's punch out. I've kind of used that analogy before, but shorter term trader here, right? We could potentially see this 520 level here kind of firm up in the market. This 520 level could be the level from which we can manage risk against. Chat, I see you guys sharing tickers. I will get to them. I'll go over the entire Mag 7, and I'll also take some of these individual crests. So I see some people talking about volatile returns. I see some people talking about banks. I will get to those in a bit. Just kind of want to highlight some of how I'm seeing the market from the top down perspective before I get into those individual charts. So keep it coming. So here we can see, right, this 550 level on the shorter term is that line in the sand. And you can kind of see here, this price action is where the best and worst days occurred, right? Below support in a downtrend, right? And so I think once we get back to 550, that's where the real fight begins. We got knocked out of the ring on that tariff news, right? And then we kind of came back to this 550 level. And when we got back to that 550 level, I think a lot of people were excited because we had this huge update, one of the best updates in the market ever. But to me, all we did is get back in the ring, right? Like, you're getting your ass kicked by the Bears. You're getting your ass kicked by the Bears. And then the bell rings, ding, ding, ding. And you go to your corner. And then you got back to 550. And it's like, shoot, I got to get my hands up and start fighting again. And you know what we did? We kind of contracted a little bit. But we are starting to see that kind of a base build here against this 520 level. So if you're more tactical, you can see RSI is kind of holding 50 where it stayed in the bearish regime in past. This might be a tactical trade you can take, right? Kind of making a higher low, breakout, false breakdown, and then you have this 520 level. But this is a shorter term chart. So that's how you can kind of use those two time frames to kind of maybe take two different trades in your trading account, right? And so that's kind of how I think technicals can help you to a degree, is you can evaluate the market from multiple time frames and understand what's occurring. So that's kind of what I wanted to highlight, right? There's this environment right now is messy. I'll get to those charts now. But the next thing I just kind of want to talk about is our secret superpower as retail, right? So the secret superpower as retail is the fact that we can wait, right? We don't have to be invested 24/7 in the market. We can take time off. We can sit in cash. And that's something a lot of people don't have the benefit to do, right? They have clients to answer to. They have phone calls they need to respond to. They can't sit in cash and wait for the market environment to get better. We can do that, right? Just a couple charts I'll share here, kind of reiterating this, starting with, right, the NASDAQ new highs minus new lows. right? So there's technical things that are telling us, hey, the market's messy. Maybe we just chill out, right? Maybe we don't have to take every single trade that everyone else in the market is taking in a high volatile environment, right? Look, right? New lows on the bottom panel continue to dwarf new highs on the NASDAQ, right? NASDAQ composite. Let's look at the NYSE. Same thing. New lows continue to dwarf new highs, right? So the environment is telling us we still do the work. The environment is telling us, hey, if you're retail and you can sit out of the market and have no one to answer to, and you can wait for the fat pitches to swing the bat, why not wait? Why not wait for some clarity in the market? And so that's, I think, one of the things, the secret superpower that we underestimate as retail investors sometimes, is the fact that we can wait, right? We can wait for the market to clear up. We can wait for well-defined risk levels. We can wait until the S&P 500 gets back above 550, right? We can wait until the percentage of stocks above 200-day improve. Those are things that a lot of people can't do that we're able to do, is swing at only the fattest pitches, right? Fish in only the ponds that are stocked with fish, because there's no asterisk in our account that says, oh, you know what? Larry only made money when the market was looking good. No one says that, right? The money spends the same, whether it's easy trades or hard trades. I think there's a lot of hard trades out there right now. And just because you can take them doesn't mean you should be taking them. Look at S&P 500 new highs minus new lows. Very messy, right? New lows continue to dwarf new highs, right? Those are not features of a market environment where you have a lot of high probability trades to be taking. And so last thing I kind of want to say on this topic is we'll take a look here. We'll take a look here at percent above 20-day, 50-day, 200-day, right? You have 10% of stocks above a 20-day. You have 15% of stocks above a 50-day. You have 25% of stocks above a 200-day, right? And if you reverse engineer that, essentially, right, 8 out of every 10 stocks is in a downtrend, long-term, intermediate term, and short-term. And so you're fighting an uphill battle from the intermediate term swing trader perspective. Maybe you take those shorter term trades like we talked about against 520 in the S&P. Maybe you look at some very clean risk reward levels, but this isn't a point in the market yet where we have the green light to just go ahead and be taking a ton of trades. And so that's just something I want to preface, not something you're going to hear a lot, because right, people are going to push you to do things, right? They're going to tell you you can make money in this environment, and you can. It's just a lot harder than normal. So just keep that in mind, and maybe you shrink your position sizes down. That's what a lot of the greats do, right? They fight the battles that are easy to fight, and we can do that as individual investors. So that's kind of what I wanted to highlight there. Next topic I wanted to talk about with you guys is something I've seen a lot this week. And it's this concept of you don't want to miss the best days in the market. And I saw a lot of people talking about, this is why you stay fully invested. This is why you stick to the plan, right? And I agree, right? If you have a plan, stick to it. But just arbitrarily showing data about, you can't miss the worst days, you can't miss the best days in the market because your returns will be skewed, yada, yada, yada. Like the chart like this, right? Where you see annual return from 2002 to 2021, right? Which also doesn't include the financial crisis, or doesn't include the dot-com bubble, which a lot of best and worst days occurred in there. But you look at this chart, right? If you miss, right, the best, right, 10 days, 20 days, right? You see how your returns get smaller and smaller. But the problem is this suffers the omission fallacy and the framing fallacy. What's it omitting? It's omitting when it's omitting when the worst days occur and when the best days actually occur, right? And we can look at that information, right? We understand that bull markets are built on quiet strength and bear markets are very noisy. There's a lot of things that occur with little progress. Bull markets, there's not a lot of things that occur and we make a lot of progress. So this volatility regime is a feature of a bear market, right? It's a feature of a messy market, right? Best days and worst days don't happen in strong uptrends. They happen in downtrends, right? So I kind of have a chart here that I'll show you guys to highlight that. Right? Let's just take a look. Here we go. Okay. So in this bottom panel here is rate of change, 1-day rate of change. And on this top panel is the shaded area is the 200-day moving average of the S&P 500. You can see on the bottom panel here, right, that a lot of these up days, right, up days like we just had, where's it occurring? Below the 200 day. It's occurring in a messy market environment. We go over here, right, to 2022, which we look at the chart, downtrend. When are these high and low days occurring? They cluster together in high volatility environments when the market's messy. Let's look at COVID. A lot of the best and worst days occurred during COVID. When? When the market is in a downtrend below the 200 day, right? We can keep going and we can keep doing this exercise, and you guys can see that these occur when the market is messy. Bull markets are built on quiet strength, and bear markets are very noisy with little progress. Keep zooming out on the chart, right? You can see here 2015, right? When did they occur? They occurred in the downtrend, right? So you can use tools like volatility, breadth, and trend to understand that these are going to occur in messy environments, and all people are doing when they share that data is they're bragging about being invested in downtrends. Just not something I think we should do. So what we should do is you should look at the data for missing the best and the worst days, and you actually see that your returns are better over time when you do that. When you miss the best days and the worst days, which is AKA when you miss the downtrend. And that's kind of this other data point I'll share from my friend Willie Delwich, who's the founder of High Mount Research, right? He has data going over this, right? So let me share that here. Right? This is not omitting data, right? We can see here, volatility is a tax. Avoid it when you can. S&P 500 annual returns from 1990 to current, right? Look what happens when you stay fully invested, right? Fully invested, 7.9% return, deviation of 18%, right? When you miss the best 100 days and the best 100 worst days, which occur similar times in downtrends, aka when you don't stay fully invested in downtrends, look what happens. Your deviation decreases, right? Which means smoother returns, and your actual return goes up. So this is one of those things where, right, when you're an investor, you want to do something that's sustainable. And what's sustainable is trying to stay out of downtrends in the market, right? You don't have to stay fully invested in the mess. So that's just one of those things that I think people don't understand about the market that I think is key for people to understand, is that when you miss both of those days, you actually do better off, which is a feature of not being invested during downtrends, because a feature of downtrends is high volatility markets. So that's kind of my 2 cents today, guys. Let me know what you think in the comments. And now I'll kind of rip through some of these tickers because I know the chat's buzzing. Chat, what do you guys think about missing the best and worst days, right? Kind of let me know your guys' thoughts. Shout out to High Mount Research and Willie Delwich for this. But I just kind of wanted to take time to highlight some of this data and help you guys understand that we can look at this stuff more wholesomely and make better investment decisions as a whole. So cheers to that. I'll stop sharing and let's go over some individual charts, right? Let's rip the charts, as they say. All right, ticker request, starting with TSLL. All right, let's take a look at TSLL. Oh, what are we doing here, guys? What are we doing here? All right, this thing is a catastrophe. I don't know. Are we taking this short, this Rainmaker? Are we taking this name short here? What a Tesla bull. I don't know why we're looking at these leverage funds right now, right? The market's already volatile enough. I don't necessarily see a great trade here. I think we're in a downtrend. Yeah, we're in a pretty strong downtrend here. Highlight a few things for you guys, right? You can see here, right? RSI is in this bearish regime. Bearish regime for the RSI. The 50-day is crossing below the 200, right? Actually, that tends to mean we might be closer to a bottom in a lot of charts, because by the time this occurs, a lot of the downtrend has already occurred, which you can kind of see here. But I don't see any trade here, right? Like I don't see a setup that's conducive to making money, right? I'll get to the Tesla chart later, but I don't know why we're necessarily looking at this. Are we looking at these lows here? Is that what we're doing? Maybe this is what we're looking at. I think there's much cleaner charts out there. I don't think we need to take a stab at something like this. Um, yeah, just I think we can avoid this altogether. I don't see a setup, right? Maybe if you are in this, you manage risk against the $6 level, but I don't really see a trade here for the chat. But I understand some people want to use leverage products, right? But just understand there's a lot of risk with them. But yeah, not a type of setup I'll look at. COHR. Let's take a look at COHR. Coherent Corp. Guys, these are some messy charts, right? Messy environment, right? This is where kind of I was highlighting earlier that all the data I was kind of reviewing was a culmination of a lot of individual charts, right? That's what breadth data does. Is breadth data kind of gives you the view of a bunch of individual charts. And so, yeah, let's take a look here at this one. All right. Yeah, Coherent, not necessarily a fan here, right? Against $50, maybe that's what you're looking at. Right, strong downtrend, weak bounce, up 7% this week. But where did it occur? Right after, right, a really weak week before, right? Like we kind of said, these volatile environments tend to occur in downtrends because volatility is increased in these types of names, right? Another way for you guys to kind of look at volatility, right, is this thing called average true range, right? So we can look at the average true range, right? And even as this stock price decreased, right, the average daily range of the stock continued to increase, right? That's a volatile environment, right? And volatility is not normally a feature of strong uptrends, right? It's normally a feature of weaker environments, but you can kind of see you do want some volatility to kind of get back, right? And that's what happens. That's why the best days occur, is because you kind of get back. It's called snapbacks, but trend changes don't tend to occur here, just snapbacks, right? Back to square one, right? So Core, I don't really see a trade here. Great earnings, but volatile results, right? I think that's what this chart's showing, right? Earnings aren't a great timing tool, right? They tend to lag the market by 3 months, right? Not like crazy, but I don't see a trade here. Let's zoom into the daily, right? Let's take a quick daily look. Yeah, I don't know, man, right? RSI in the bearish regime, well below the 200-day. Right? Maybe if you need to take a stab, right? You're a junkie. You have kind of this clean level, right? You could have a scoop and score here, right? This false breakdown on this daily chart. But I think there's a lot of overhead supply here, so I would just be cautious. But that's kind of how you could look at it is, hey, I might take the trade against 55, but we didn't have any follow through, right? We had that big up day, but we didn't see any follow through. And we want to see follow through in stocks. And you can see on a relative basis to the S&P 500, right, it's trading downtrend. So a couple things I look at. Overall primary trend is down, right? At best sideways, right? That's me being super generous, but it's down. Relative trend, right? Relative to the S&P 500, it's down. So you'd make more money just being in the S&P 500. Thirdly, right, momentum is in a bearish regime, right? And we're below overhead supply. So don't really see an investment process here, but like we talked about, right? The markets, you have tactical ability in the market. And so one thing I would do here, right, is maybe you do play the scoop and score, right, against this 52 level, right? Let me actually look at the exact level here, right? This 52.80 level, right? So then if we zoom in to even shorter term chart, right, we're below this short-term moving average. See, I don't see any clear trend here. So core, not something I want to be invested in, right? Maybe, I mean, you could take a short below that 52 level, but if this scoop and score doesn't kind of see through, I see no reason to be in it. But I like where your head's at. Thoughts on banks? They reported this AM. Yeah, let's take a look at some of the banks, huh? JP Morgan, look at that candle, right? That's a good looking candle in JP Morgan, right? Long-term uptrend relative to S&P 500, right? This is one of the bellwethers when it comes to banks. And so I think, right, the chart didn't necessarily give you on this time frame like a great entry, but I think the daily probably has a better setup. Still, it's not the cleanest in the world. We're trying to get back above this 200-day. Right, trying to get back above this 200-day, seeing some relative strength here, right? I think you got to get above this 200-day in the bank here, right? I think 230, you got to get above the 200-day. You got to get RSI back above 50. You have to see follow through. because they're below, right? Because honestly, what this could do is this could just break down, right? This 200-day can turn into resistance here, and you actually might have a good short. Because I was actually looking at that the other day. I shared this chart on Twitter, right? So here's an example, right? The relative strength started to break down a little bit in the bank's financials, and we were testing the underside of the 200-day when we had that strong up day. And you see here, we kind of retreated a little bit. So I think you need to see follow through, right? It's guilty until proven innocent. I think you need this follow through in these types of names because right now we're not seeing it, right? We're kind of seeing a stall and sideways, and the primary trend's down. So, but if you like JP Morgan, all right, here we go. This is kind of your level, a level I would highlight. All right, resistance, resistance, gap up, turned into support. We're kind of back above there. So 225 would be my risk level, right? If this is something I was in, I would manage risk against 225. I wouldn't want to see new lows. Maybe we make a higher low here and continue to work up. But 225 is kind of that level I would manage risk against in something like JP Morgan. I don't know if Goldman Sachs reported today, but let's take a look at the Goldman chart. Goldman, not as good, right? I like that JP Morgan chart a lot more than Goldman. What we think about Wells Fargo, take a look here, right? You kind of have this polarity zone in Wells Fargo, right? Wells Fargo was a bank that kind of broke out, right, against the 60 area. That's kind of your level in Wells Fargo. Right, you can see the base. Right, you have some underlying support here. That would kind of be my level in Wells Fargo. Be quick with this one. Right, flipped it. But man, we need to see some follow through. But 60 is kind of the level on Wells. Right, let's zoom in a little bit. Right, you can see that same level. Right, 60 is kind of the level on Wells. But we'll below the, there it is. Right, got to see follow through above 60 and something like Wells. Doesn't look that great, right? Don't know if I like this name. I think later stages, right, or early stages of a bear market or a market that's messy, right, in a downtrend is they take out the leaders, and the financials were the leaders, right? So want to see follow through from these names, not currently seeing it. Something I'll do here is I'll give a overview of just the banks in general. I think that's a good good little thing we can do real quick. So let me share this tab. Right, so here we go. Let's take a look at financials. Right, Berkshire's holding up well. JP Morgan, big day. Visa, MasterCard, right, they look decent. This is the past 5 days. All right, let's see these one-day changes. Kind of mixed in the financial sector overall. I think the names that are a little bit safer in the financial sector, right? You have Berkshire. You also have the insurance names. But I think in general, these banks, they need to see follow through, right? The overall trends are kind of broken in general. So we need to see that repair, and that repair takes time. But I think in general, it's a decent place that if you do have to have money in it, right? You do have some clean levels in some of those banks to manage risk against. But it's probably just going to take time. Let's look at Bank of America real quick. Ugly, right? One of the uglier banks. Kind of looks like that Coer someone brought up. But yeah, not necessarily an area I want to be fishing in because there's not many areas I want to be fishing in. I'm kind of just hanging out at the moment, right? Waiting for this kind of volatile environment to kind of clear out. Play. Let's take a look at Play. Dave and Buster's, right? Zooming out on the chart, you guys get the deal by now. Right? Downtrend, right? About to get oversold again. One of the beauties here of this RSI is you can see on this weekly chart, right? What do downtrends do? They get rejected at 50 RSI, right? Bulls can't get control of momentum. And then what happens? Reacceleration back to the downside in something like Dave and Buster's. So downtrend, but it's almost oversold again. You can kind of see here last time it kind of got this oversold reading. Not a time to be pressing shorts, right? Oversold is not a time to be pressing shorts in downtrends, right? You press shorts at overbought in downtrends, right? So let's kind of take a look, and I'll give you an example of that. Right, so that move, right? See this overbought that occurred, right? When we cross back below, see this 50-50, but then when we got overbought again, that's when you maybe press a short here. But this is in the downtrend. I don't see really a trade in this name. Right, if you're in it, you should have been managing risk already. And a way you could have done that is maybe the 200-day, right? Maybe this 42 level, but not a name I would be in at the moment. And unfortunately, guys, like, I'm just going to be honest with you, right? Like, I'm not going to be in a lot of trades right now because I already showed you the majority of stocks are going down, right? And one of our benefits is we don't have to be in stuff. The Masters is on this weekend. Go watch the Masters. The weather's beautiful, right? Spring's in season. Go outside. You don't have to be taking trades because the more money you have in your account right now, right, that's more money you can then compound when the market is back in its uptrend, right? When it's quiet strength again, when there's tons of trades to be taking, because that time will come again. Don't bleed out in the meantime, right? Hold on to those funds that you guys have. TMDX, please. Let me take a look at TMDX. Shout out to Rookie Retailer. Triangle set up, breaking out to the upside. Okay, let's take a look at this. Are we talking a weekly chart? Kind of have a scoop and score here. It's kind of messy though. Kind of messy. Don't hate it. It's kind of messy. Kind of a messy chart. Yeah. See, you have some overhead supply in this area from 70 to 90, right? Didn't get oversold, which is big, right? Didn't get oversold. Has been outperforming, right? Looks great on a relative basis. When we zoom into this daily chart, right? When we zoom into this daily chart, right? It has not, right? It's kind of been gaining its footing this year. Right? I think this gap up is a struggle, right? I think this 200-day is probably a struggle. But you're onto something here, right? Like if there was a trade I was looking for, right, it might be something like this, something that's building a base, right? Something that's not going down while the rest of the market's going down, right? RSI is not getting oversold, right? Got oversold last year, but now looks like it's kind of leading the market. Maybe it can get out of this mess. Yeah, don't hate it. I think this is one of the better charts we've seen, but I still don't necessarily see a great way to trade because, right, wrong font. Think you have some risk here, right? But if you're in it, right, I would just set a trailing stop. But I think there's probably some overhead supply in this area, right? Probably some bumping into some issues here, but it's building a base. So if this is a longer term play for you, maybe just hold on, set a trailing stop, maybe against this April low. How far are we looking? We're looking 17% though, right? So this is one of those things I don't see a great risk reward at the moment, but if you're in the name, I don't see a reason to get out, right? I would maybe get out if we start to break down. You could see here a couple other times we've had resistance at this $80 level. So see if 80 kind of turns into resistance. Maybe you sprinkle, right? You feed the ducks a little bit in that name. But it's a better looking name overall than some of the charts that we've seen. Another comment in the chat. Missing best days. Many beat down tickers will run on tariff relief. Exactly. Set stop buy orders on these beat down tickers at 6% to capture the big headlines. Where is RUM headed? RUM. Rumble, right? Sideways, right? Not really headed anywhere on a daily chart. Let's kind of zoom out. Ooh. Rumble's got punched, right? Rumble's not ready to rumble. I tell you that. Kind of been getting beaten up here. Something like this. Don't really see it. Guys, boring right now. But you're kind of building out this triangle, right? You're kind of building out this pattern here. Let me see what I can give you. Right? $7. Kind of a level you can manage risk against. I don't really see a trade, right? Maybe against 7, you're long, but you have overhead supply. You can see RSI here. staying in this bearish regime, getting rejected above 50, doing what a lot of stocks are doing, looking messy. And that's the environment we're in. That's the beauty of these technical charts that I've shared, right? Is the fact that we don't have to sit in this shit. We can just chill out, right? Cash looks good, right? Cash looks good right now, right? Yields are rising at the moment, so you're getting even more on your cash account. So I think, and I don't think it's time to play hero ball. I don't think it's time to be Mr. Tough Guy. I think it's time to take advantage of that retail superpower you have and wait for it to clear up. We still do the work, right? We still look through the charts. We still look for the setups, right? That's what I'm doing. I'm looking for capitulation, right? Looking at these new highs, minus new lows, trying to see the environment, trying to see where the VIX is going. I'll kind of share this here with you guys. Should share the new high, new low again, right? Most stocks are going down, right? But this is capitulation, right? So this is capitulatory. So I wouldn't be pressing shorts here, but I would be looking for follow through to kind of get long. And we haven't seen that follow through yet, right? So we want to see that follow through. Kind of see here, same thing. I want to see the follow through in these types of areas of the market before I'm over here swinging the bat too much, right? 520 is kind of that level like we talked about in the S&P. But let me go through the mags real quick, and I'll also talk about Bitcoin, right? IDR, gold, and rare earths. For sure, gold is the place to be, right? If you have to be in something right now, gold is the place to be. Great note there about M Chromatic, right? Gold looks great. GLD looks great. Bitcoin, right? Still in this torture chamber. It's holding up okay, right? Holding up nicely relative to the market, but I think we got to see the market just has to prove it to us, right? What am I doing here? Let's look at gold, right? This is crazy. Strong uptrend in gold. And we've talked about it before. This is the largest holding in my portfolio. Really, all I own right now is gold, silver, and some insurance companies. But if you look at this monthly chart, right, these moves occur in gold and they last a really long time, right? This 2010, right, to 2023, 2024 base, that was the breakout. And then this is why the trend following works. It's because you just set a trailing stop and you let it go. Look at that, base on base, beautiful, right? And then you just set a trailing stop and let her go, right? So gold looks great. Does it look extended? Sure. But I think one of the things people miss is a lot of people talk about bonds being the safe haven, but gold does much better when it comes to allocation in a portfolio mix, right? If you have gold and stocks, right, you tend to have a better Sharpe ratio, a smoother return profile than you do with stocks and bonds, because bonds don't look great. All right, let's look at something like TLT. Right, this is that safe haven people are talking about. This is why you have bonds in your portfolio. Yeah, right. This is a mess. Those same people are the best day, worst day people, right? They're the worst people. It's like, I'm just kidding, but you kind of get it. Like, this is just, bonds are a mess. Yields are going up. Gold looks good. If you don't have gold exposure, I would add some gold exposure. Yeah, is it in a strong uptrend? Sure. But look at some of these miners, right? This is a name, Orla, right? I know it's ran a lot now. But what can I say? Those were kind of the areas, right? You had the same thing here. And these are the setups we'll be looking for once the market gets back its feet back under it, right? Those nice big base, low overhead supply breakouts. And we got one in Orla, right? So gold is a good looking spot. Shout out to the chat. Gold does look good. When I run a lot of my relative strength ETFs right now, a lot of it is gold names, right? A lot of it's rare earth thing. So that's kind of the spot you want to be in, because it's not necessarily inflation. I don't know if inflation is the worry. I think uncertainty is the worry. Because when you look at something like energy is just trading sideways, right? Energy's been trading sideways since its 2022 peak. It's made no money. No money. No money has been made in energy except by people selling premium. Right? No money. Look at the opportunity cost in sitting in something like this for this period of time, right? If you would have sat in energy instead of just owning the S&P 500, right? This is what we're looking at, right? This bottom panel, right? Downtrend. Right, since 2023, there's opportunity cost in being in this mess. So I don't think inflation's the worry, right? I think it's something else. I think growth might be the worry. I don't think it's as much of inflation as people think it is. I think the tariff news is more of a growth scare than it was an inflation scare. And I think people are worried about what the Fed can do. So people aren't flocking to energy with their worry, they're flocking to gold, right? So just something to keep in mind. Let's run through the Mag 7 real quick and then we'll get out of here. Let's run through the Mag 7. All right. So these charts have been edited in the past, haven't made any updates. This is something I was talking through last week with Apple, right? Where are these best, worst days occurring? In downtrends, right? When you shouldn't be in these names, right? You're bragging about owning downtrends when you're bragging about catching the best days, right? Or you're lying and saying you only caught the best days. But we're probably going to get smacked in the face when we get back to this 205 level. RSI isn't above 50. It's just an oversold bounce. Don't see anything in Apple that I like, right? Tactically, sure. You can put on a really short-term trade in something, right? You're kind of seeing it on a shorter-term basis, right? This is just 10 days. This is the past 10 days, all right? So tactical trades might work, right? You kind of have well-defined risk against 195. This is ugly. Let me update this, right? Against 195, but those are quick trades, right? You're glued to the screen all day if you're doing something like that. Look at mags as a whole, right? Mass E, we already would have been out, right? The best day in mags history occurred. Imagine if you missed it. I did. I'm thankful I did, right? I missed it. Hand up. I missed this. Why? Because I got out at 50, right? And then I didn't have to endure this drawdown. Because what they're assuming is that, right, it drew down another 20% when we got below 50. Cool. It had this big 13% day, right? But guess what? You're still down another 10% when you could have already gotten out. Trend already told you to get out, right? And this is where most of the best and worst days occur, guys. So not something I want to be interested in. Still kind of in this relative downtrend relative to the broader market. And that's going to weigh because we know these names are so important to the broader indexes. Hopefully, right, we can see this RSI change here and get back above 50, right? Highlight it here. That's when the money was made, when the bulls were in control of momentum. And then when the bulls lost control of momentum here and the bears took over, messy market, right? We don't have to be swinging the bat, guys. Meta, right? Meta against this 550 area is where I like Meta. But then you have overhead supply, and you can see here that Meta's getting beat up, right? Still below this 200-day. Had its probably one of its best days ever. Where? In a downtrend when you should have already been out, right? You should have already been out of this a long time ago. And so we have to get back above this 540 level. Then we have to fight with the 200-day. And I want to see this RSI get back above 50. Right? So still uphill battles. Right? Take some tactical trades, short-term traders. Right? Maybe you have a tactical trade here, but I don't see it. Amazon, same story. Right? We need to repair. Get this RSI back above 50. Right? And if you guys are looking for trades, one of the things I would do is I would run a scan. Right? Stocks with RSIs above 50, stocks above their 200-day. That's probably a good place to start because those names probably look a lot better than these names. There's a couple names that come to mind. Crowd, right? RSI above 50, right? Above its 200-day. Built this kind of double bottom here. That's not a bad looking chart, right? You don't want to own individual names. Look at something like Cyber. Cyber's starting to get back above that 200-day. Right, zoom out on a chart like cybersecurity ETF. Right, zoom out on something like this. Right, pretty clean risk reward. I know it's already up 8% this week, but Cyber looks decent. Cyber's a spot where you could be fishing. Names within this ETF, names within Hack, right? Another cybersecurity ETF, right? You can kind of see this base, clean levels. Right, cybersecurity looks decent. I think cybersecurity probably, I think tariffs is probably a tailwind for cybersecurity to some degree. Never got oversold like the rest of the market, right? Daily chart looks better, right? Trying to get back above that 200-day. Cyber's not a bad spot. Look at names like Palantir, right? Never broke below its 200-day, right? Holding up really well in this tape. I think Palantir's a name to keep an eye on. All right, App. I think also App looks good. Right, above its 200-day, right? It needs to kind of get going again, but I would be looking for stocks that are above RSI 50, stocks that are above their 200-day, but that list is small, right? And that's kind of the point here, is that those lists of names are small. So, guys, that's what I have today. Shout out to the chat for sharing some tickers. The lessons today were simple, right? Don't overcomplicate the market, right? Understand that there's a superpower we have, and that's the ability to stay in cash until the market clears up, right? We can fight the easy battles. We can take the easy pitches, and there's not a lot of them out there right now. And last thing I want to say is, if you guys enjoy these types of talks, I do them all the time. I also have a Twitter at Hostile Charts. You can follow me. Stock Twits, more importantly, at Hostile Charts. You guys can follow me. DM me anytime. I'll share some tickers, some insights that I have with the market. If I am taking some trades, I tend to share a lot of them on there, right? Kind of my risk reward scenarios that I'm looking at. I also write on Beehive. I write a weekly letter. And this week I'll probably be talking about some of these relative leaders, because I think there is some trades that probably could be taken. And I do want to see where the relative strength is and kind of see where those lessons are. So you can go to my stock twits, you can go to my Twitter and subscribe to my Beehive. That's also at Hostile Charts. Those letters drop every Saturday. And then once you subscribe to that, you will also get my Tuesday, Thursday letter called Thompson 2 Cents, where I share my 2 cents on the market twice a week. So shout out, guys. Have a great weekend. Appreciate the love in the chat. Shout out to the chat. And peace, guys.